Hey there, welcome back to the channel. Today, I'm going to show you why Warren Buffett is sitting on an unprecedented $334 billion cash pile, and what this might mean for your investment future. If you've been wondering about the stock market outlook for 2025 and beyond, stick around because this could be the most important video you watch this year. In this video, I'll show you the shocking parallels between today's market and the dot-com bubble that led to the last stock market lost decade. I'll reveal 3 powerful strategies that could help protect your portfolio if Buffett's implicit warning proves correct. And by the end, I'll share what might make this time different, the potential wildcard that could change everything. Let's dive right in with the facts. Warren Buffett, arguably the greatest investor of all time, has been sending us a powerful message through his actions. Berkshire Hathaway has been a net seller of stocks for 9 consecutive quarters through the end of 2024, resulting in a massive $334.2 billion cash position. Think about that number for a second. Buffett and his team have nearly doubled their cash reserves in just 1 year. This isn't just portfolio rebalancing, it's a deliberate strategic shift that speaks volumes about how the Oracle of Omaha views current market conditions. Even more telling is what Buffett has been selling. In 2024 alone, Berkshire received $143.4 billion from equity sales while purchasing only $9.2 billion, a net selling of $134.2 billion for the year. This included reducing positions in longtime favorites like Apple and Bank of America. But here's where it gets really interesting. After 24 consecutive quarters of buying back Berkshire's own stock, Buffett completely halted share repurchases in the second half of 2024. Since Buffett only buys back shares when he believes they're trading below intrinsic value, this stoppage sends a clear signal that he views even his own company's stock as fully valued or overvalued at current prices. If this situation feels familiar, it should. Let's go back to 1999 when Warren Buffett issued an eerily similar warning. In his widely cited 1999 shareholder letter, published just before the peak of the dot-com bubble, Buffett stated his virtual certainty that the S&P 500's returns over the next decade would be far less than the strong returns experienced since 1982. His reasoning was simple but powerful. Long-term corporate profit growth is tied to overall economic growth. If profits grew at around 5%, GDP plus inflation, the already elevated valuation multiples were unlikely to expand further. Adding dividends, he concluded that prospective equity returns would be dramatically less than recent experience. He was right. The market crashed shortly after, leading to what we now call the lost decade from 2000 to 2012. Let me show you exactly what a lost decade looks like for investors. From January 2000 through December 2012, the S&P 500 delivered a nominal annualized total return of just 1.4%. But that doesn't tell the whole story. When adjusted for inflation, which ran at about 2.4% annually during this period, the real annualized return was approximately negative 1.0%. That means that, in terms of actual purchasing power, investors in the S&P 500 lost money over a 13-year period. Imagine putting $10,000 into the market in January 2000. By December 2012, despite over a decade of time in the market, the real value of your investment would have actually declined. This is the harsh reality of a lost decade, years of investing with nothing to show for it. But not all investors suffered equally. During this same period, other assets performed remarkably well. Gold delivered real annualized returns of approximately 12.1%, while U.S. equity REITs returned about 9.6%, and emerging market stocks around 7.2%. The key lesson? Diversification matters enormously during these periods. Now, let's look at why Buffett might be concerned today. 2 key metrics in particular are flashing warning signs: the Buffett Indicator and the Shiller PE ratio. The Buffett Indicator, which compares total market capitalization to GDP, is currently at an alarming 185 to 210% range. To put this in perspective, before the dot-com crash in 2000, it peaked between 137 to 160%. Prior to the 2008 financial crisis, it reached 105 to 118%. Today's levels far exceed both previous peaks and dwarf Buffett's own suggested range of 75 to 90% for reasonable valuation. Similarly, the Shiller PE ratio, which compares the S&P 500's price to its inflation-adjusted earnings over the past decade, currently sits around 33 to 37. The long-term historical average is approximately 17, making today's market roughly twice as expensive as the historical norm. While not quite at the all-time high of 44.2 reached in December 1999, it significantly exceeds the peak of 27 seen before the 2008 crisis. Here's what Harry, one of our viewers, told me last week. I used to think market timing was impossible, but seeing these valuation metrics makes me wonder if I should be more defensive with my portfolio. Harry's not alone. Many investors are wrestling with similar questions. Investment strategy. Number 1. Strategic cash positioning. So what can we learn from Warren Buffett's investment strategy during these times? The first key lesson is the strategic value of holding cash during periods of high valuation. Berkshire's massive cash pile isn't just sitting idle. With treasury yields between 4.3 and 5%, that $286.5 billion in T-bills is generating approximately $12.3 to $14.3 billion in annual income. That's a significant low-risk return while waiting for better opportunities. Let me show you how this strategy might work for an individual investor like Harry. If Harry normally keeps 5% of his portfolio in cash, but increases this to 15 to 20% during periods of extreme valuation like today, he creates what Buffett calls dry powder. This accomplishes 3 things. It reduces his exposure to potential market downturns. It generates meaningful income in today's higher interest rate environment. Most importantly, it creates the capacity to act decisively when genuine bargains appear. Remember what Buffett did during the 2008 financial crisis? With ample cash available, he made a $5 billion investment in Goldman Sachs that ultimately generated over $3.1 billion in profit. This crisis alpha is only possible if you have cash available when others don't. Investment strategy number 2, valuation discipline. The second key strategy we can learn from Buffett is strict valuation discipline. Despite being worth billions, Buffett stopped buying back his own company's shares when he felt they no longer represented good value. That's discipline. For individual investors, this means being increasingly selective about new investments as market valuations rise. Let's look at what this might mean for dividend investing, a topic many of you have asked about. Instead of chasing the highest dividend yield, focus on companies with sustainable payout ratios, strong balance sheets, and the ability to grow dividends over time. SCHD, for example, has been popular among dividend investors for its quality focus and reasonable expense ratio, but even with quality ETFs, valuation matters. Consider a modification of dollar cost averaging. Invest more aggressively when valuations are below historical averages and more conservatively when they're above. This doesn't mean stopping investments entirely, but rather adjusting the pace based on value. If Harry follows this approach, he might reduce his monthly investment amount by 25 to 50% during periods of extreme valuation, while maintaining his regular investment schedule. This provides a middle ground between fully investing at potentially peak valuations and attempting to time the market perfectly. Investment strategy number 3, sector and asset diversification. The third strategy is thoughtful diversification beyond just the S&P 500. During the last lost decade, as we saw earlier, several asset classes significantly outperformed U.S. large-cap stocks. This doesn't mean abandoning your core investment portfolio, but rather ensuring you have exposure to areas that might perform differently during a challenging market environment. Consider value stocks, which have historically outperformed during periods following high market valuations. International markets, particularly those with more attractive current valuations. Alternative income sources such as bonds, which can provide stability and income. For Harry and investors like him, this might mean adding exposure to VM, JEPI, or other dividend ETFs that focus on value rather than growth, or looking at international dividend opportunities. Remember, Buffett himself has maintained significant positions in Japanese trading companies and made selective investments in businesses with strong competitive advantages. Quality and value remain his North Stars, regardless of market conditions. Why this time might be different? Despite these warning signs, several factors differentiate today's market from previous periods. AI could potentially drive a major productivity boom, unlike anything seen before the dot-com crash. Today's market leaders are vastly different. The Magnificent Seven generate enormous profits with strong balance sheets, unlike the speculative companies of 2000. The financial system is structurally stronger after post-2008 regulations. But the critical question remains. Are these differences enough to overcome the mathematical reality of historically high starting valuations? While a precise repeat of 2000 to 2012 is unlikely, the combination of current valuations and macroeconomic headwinds still suggests lower potential returns ahead. Warren Buffett's warning through his actions deserves serious attention. With valuations at extreme levels, prepare for potentially lower returns ahead. Don't panic or try timing the market perfectly. Instead, maintain valuation discipline, build strategic cash reserves for future opportunities, and diversify thoughtfully beyond the S&P 500. Remember Buffett's wisdom: be fearful when others are greedy. His $334 billion cash position suggests now might be a time for prudent caution and preparation. The best opportunities often emerge from challenging markets. Position yourself to capitalize on them when they appear. I'm curious to hear your thoughts on this. Are you making any changes to your investment strategy based on these valuation concerns? Let me know in the comments below what you think about Buffett's massive cash position and if you're adjusting your portfolio in response. Your experiences could help other viewers navigate these uncertain markets too.